Good morning, aviators. This is your captain speaking. Welcome to Basic Fighter Maneuvers.
All right. Welcome to the first episode of Top Gun's Q&A. And as I promised, the first episode will be open to everybody. And this is going to be a fascinating conversation. We're going to divide the conversation between options, technicals, and then others. So stick around, folks, but we begin with options. And the viewer here says, I have a question. I've noticed the last few times I've done a put on an earnings call that I was correct on were not that profitable. Unlike a call options where I'm right, gains are amazing. Is this a common fact or just randomness? It's kind of hard to say without knowing the specific example, but I'll show you two recent examples, one to the upside, one to the downside based on earnings. So the most recent one we got is FAST Fastenal. You can see that the stock rocketed by over 10% on Friday's session alone. If you bought the call options on Fastenal, you probably scored big. And likewise, a recent reaction to the downside was Moderna, mRNA. Right after earnings, the stock went down by over 20%. If you were on the put side of the trade, you probably scored big. But there is something you need to understand about pre-earnings plays. And this is why we do lottos in this channel. We don't do significant trading before earnings. And the reason behind that is you're not going to outsmart the market maker in, say, at least 8 to 10 times. The market maker is going to win. What am I talking about here? I'm talking about the pricing of premiums before earnings are released. The market maker's job is to figure out the risk that they have to assume. If the results are bad, how far can the stock go to the downside? And if the results are good, how far up the stock can go? And they'll do a pricing based on that. So for example, when we say the market maker is pricing in an 8% move up or down or a 10% move up or down after earnings, meaning that anything all the way to 10% up or down, you're not going to make money if you bet on it because the market maker already priced that in. So earnings plays are basically playing the game of, oh, the market maker is wrong. Whatever they're pricing in, 5%, 6%, 10%. The move after earnings are released will be bigger than what the market maker has already priced in. That's the game that you're playing. And again, 8 times out of 10, you're going to be beaten by the market maker. They have billions of dollars, algorithms, they spend a lot of money to figure all of this out. But let's talk about the phenomenon of, and again, I don't have the specific examples, but why do we see overreactions to the upside more than we see to the downside, at least recently? Of course, there are horrific examples where we see stocks losing 20, 30% of their value in one shot after earnings are released. But let's say for the most common stocks, the bigger stocks, usually the reactions to the upside are more aggressive than the reactions to the downside. Why do we see this phenomenon? Assume that we have stock X, and this stock is either Apple, Google, one of the popular names, widely traded names. You have the stock price heading into earnings, whatever price that is. Let's say that in the case of an upside reaction, the report is good, and that's the trickiest part. How do you know it's good or bad? Because sometimes we see stocks reporting earnings that beat earnings expectations by the analysts, yet the stock goes down, and vice versa. So why do we see this phenomenon? I think, like I said before and explained multiple times in this channel, the reactions after earnings depend on what was priced in prior to the report coming out. And this is why we say the bar is way too high, the bar is way too low. If a stock, for example, been getting hammered, bruised, down 10, 15% heading into a certain print, and then we have unexpected good news, the bar is way too low. So we see sizable upside reaction. And the same goes, let's say, for a stock that's been rallying 10, 15, 20% into earnings. And then the report comes out, and it might be a good rating, but the bar was set way too high, as in the stock priced in a better story than reported. So we see a reaction to the downside. But from a mechanical perspective, suppose a stock heads into earnings, and we get a quote-unquote good results, and the algos read it that way. You have to understand that we have calls that were bought pre-earnings at higher prices. So every time the stock heads higher, we'll face certain calls in the options market. What happens in a positive reaction after a certain report is out, the shorts who are betting for a downside reaction begin covering right away. And that's the first set of buyers. And as the shorts cover by buying, we see calls being hit. Calls being hit meaning calls that were out of the money now become in the money. What is the market maker's obligation? Because they're the ones selling all of these calls. When they sell a call, they're obligated to buy the stock at whatever price it's trading at the moment, which is higher than what the call strike is, and they have to sell it at that strike to whoever bought the call options, meaning the market maker will be at loss. So they try to protect against the calls that are not already in the money. All of these calls that are out of the money right now, they try to hedge against those by buying the underlying stock. That way they buy at lower prices, and if they have to deliver these shares for call options holders, they deliver them at a win, not a loss. And since now you have two sets of buyers, the shorts covering and the market maker buying to hedge against upside calls, you see oversized reactions to the upside. And if you're on the right side of the trade in that circumstance, you're going to score big. Then, why do we see big reactions? Let's say stock pops by 20%, then it cools off and it settles at 15 or 12%. Because as the short covering happens and the market maker continues to buy, there is a counter force. And this counter force is the stockholders of that particular equity. They begin to book profits. The higher the stock goes, the more we see profit booking. And it kind of balances itself out. But the psychology goes, if you own a stock and it pops by 20%, sure, maybe you'll be incentivized to book your profits if you were looking to book your profits to begin with. But for most holders, when they see a huge upside, they think there's more to come. So this counter force is weaker than what we're going to see in the downside reaction example. Keep that in mind. So in this case, we have a stock price heading into earnings, and then we get bad news. They missed, or they expect that the margins will be worse, or they lowered the guidance, whatever it is. Understand that underneath the stock price, there are puts, folks who want to short the stock at a certain price. And immediately, once the disappointing report comes out, the holders already have the algorithms set up. They begin to sell their shares because you want to sell at a higher price than a lower price. As the selling goes on, you want to be in the beginning of the selling phase, not at the end. So we see an oversized reaction to the downside. Then these puts begin to hit, becoming in the money. What is the obligation of the market maker who sold all of these puts to the holders? They have to buy shares of that underlying stock at these strike prices that they sold the puts at. What if they buy at the second put, for example, as you see in this chart right here, but then the price goes down to the third put? Well, they bought and now they're at a loss. So what they do is they begin to sell at higher prices. They sell their shares at a higher price. So if they have to buy it at a lower price, they're not eating a loss. So we see the selling accelerating. The holders are selling, the market maker is selling, the hedge against the puts underneath the stock price. What is the counter force? The counter force is the dip buyers. The stock goes to a certain price, the dip buyers begin to buy. And among the dip buyers, so you got the dip buyers number one, the other force is short covering. If the stock goes down 10, 15%, maybe you made your goal from a certain short. So you begin to buy along with the dip buyers. And guess who joins the buying spree? The market maker. Because they sold the shares at a higher price. And if they buy along with the other two forces, the puts become out of the money, meaning the price of the underlying equity becomes above the strike prices of the puts. And now the market maker no longer has obligation. And this is why when we see downsized reactions, at least in the popular stocks and the leading stocks, usually they don't last too long. They're bought right away. Unless the news is really, really bad and we see more and more holders exiting their position, then we see the inverse gamma squeeze phenomenon, where the market maker has to continue to sell because the risk becomes that the price would be lower by the holders of the underlying equity selling. So maybe that explains your question that maybe you buy a put at an underlying equity. The report comes out, it's negative, and you see an oversized reaction to the downside more than what the market maker priced in pre-earnings. If they priced in 8, now you're getting a 10% to the downside. But because of the counter force and the way the market maker thinks about, hey, if I buy, I can make the puts out of the money again. Because of that phenomenon, we see rebounds fast. Not in all cases, though. But because of this, we see rebounds and then the puts that you bought and you needed 10% plus as a reaction to make some money. Now you see the stock down 7-6%. All of a sudden, you're losing money, or you're not making as much gains as you would have made in an upside reaction case. When we see a stock blasting by 20% and we see buying continuing. It's called a combination of a gamma squeeze and a short squeeze, multiple forces of buying at the same time. And unless the holders of the underlying equity counter them with huge amount of selling and profit taking, we usually see the reaction to the upside sticking. So I hope that answers your question, at least a little bit of it, because I don't have the specific examples to really answer your question specifically. But this is an important mechanical phenomenon for everybody to understand. And here we have another question from David. Thanks for all that you're doing for us. It may seem like all your efforts are unappreciated from few naysayers, but rest assured, the majority of us are all grateful. We pray for your health. Thank you so much. Appreciate the kind words. Here's the question. You often state to use SLV to hedge gold if there's an event coming up. Can you give an example on how to hedge 500 shares of PHYS, this is physical gold ETF, this Friday? There were to be Fed announcement. Of course, the Fed announcement already happened, but again, we'll answer the question for future events and most importantly, technical setups. It's not really about the events, it's about the technical setups, one step at a time. If we look at the physical gold ETF, the first thing we want to establish is when did we see pullbacks and how big were they? And here I pointed out some examples for you. You see when physical gold went down by 5%, 3% and a change, 2% recently. Next thing we want to do is overlay the chart of silver on top of it, SLV, and see if there's a correlation or not. Is it the case that when physical gold goes down, we see SLV also going down or not? Because if it doesn't, then it's not a good hedging mechanism. And here we can see that among the reactions where we've seen physical gold going down, we've also seen SLV going down. And I made a mistake here. I kept the physical gold downside of 5.09%, but the SLV at that point was down about 10%. So you can see that SLV goes down along with physical gold, but usually goes down double the percentage point that physical gold goes down with. Meaning if physical gold goes down by 5%, we see SLV down almost by 10%. So with that understanding, we know that we have a 2-to-1 kind of reaction of SLV versus PHYS physical gold. Suppose if we go back to physical gold, the chart, daily chart right here, we want to hedge for, let's say, a 4% or so downside movement all the way till November. So you say you got 500 shares at the current price of 20.64. You have about $10,320 invested in physical gold. If the stock goes down by 4%, then you'll be losing $413, give or take. So our job is to pick a hedge that can protect against a loss of $413 minimum. So we go to SLV. We shop for the options, and we go all the way to November 15th, because this is where we want the hedge or the insurance policy to last. In this case, the sweet spot is the 27 puts, because if you buy those right now, 5 contracts to hedge against your 500 shares of physical gold, you can always buy more or less, depending on what you like. Some folks want to make more gains on the downside, so they buy more than what they have. You can always buy more than what you have, but you cannot sell more than what you have. So in this case, we stick to the example that we got. So we pick 5 contracts of the 27 puts, November 15th expiration. Cost us about, let's say, $2.20 a piece. Or shall we say $220 per contract. Now suppose the SLV, if you look at the table right here, suppose that the SLV goes down by 8%, meaning that physical gold is probably down by 4% or so. So long as it happens all the way till half or the midpoint until the expiration date, in this case it's going to be October 30. If we go down by 8%, you'll be making more than 100% on the insurance policy that you just bought here, the SLV 27 puts, meaning the $220 will become a minimum of $440, meaning that's going to shave your loss in physical gold by more than half. And that's usually the goal of a hedging policy, is to reduce the loss to give us the room for maneuver and reassessment on the original investment. In this case, your physical gold ETF. Instead of losing 4%, you're only down less than 2% now. Of course, if you want to protect the entire shares that you got, entire loss on physical gold, then you need to buy more of the insurance policy. But the goal of an insurance policy is not to cost too much, to spend $400, $500, and then we see the underlying stock that we're trying to hedge against actually going higher. And now we've wasted $400, $500. And to compensate for that, we need to see a bigger move in the underlying equity that we own, in this case, physical gold. So usually you aim for 50% when you're using another asset, a proxy asset, as a hedging mechanism. Because in this case, in physical gold, you don't have options. You don't have put options. Otherwise, you could have utilized those instead. You could have bought the put options of physical gold, assuming they were available. And at that point, you pick the price where you want to exit your shares at. If it goes below that number, then there's something changing in the story where you don't want to hold the underlying asset anymore. And buying the put options, in this case, 5 put options, if, again, hypothetically, physical gold put options were available. If you go a certain price, you're going to preserve the right to sell your shares at that underlying price. So you have the hedging policy and the option of selling your shares if you're using the same options for the equity that you got, not a proxy. In this case, SLV. So that's one thing you have to consider when you, for example, debate, should I buy physical gold ETF or GLD ETF? I'm overlaying both of them on top of each other, GLD and then physical gold on top in green. You can see that we have identical performances, but the difference is you don't have options of physical gold, but on the GLD you do. Now, the reason why I use SLV puts to protect GLD is usually at least in the weekly to the, let's say, bi-weekly put options, on the SLV, usually they're cheaper than the GLD. But if I want to hedge for real, if I'm worried about a drop of 5% that changes the upward trend in gold, I would use GLD put options because I want to preserve the right to sell my shares if indeed there's a crash. The other important thing to understand about hedging using these put options, be it the underlying equity that you own or a proxy, doesn't matter which one you do. When you look at the GLD or gold or even silver, all of these metals are sensitive to the dollar. So right now, as you can see, the inverse correlation, the dollar is in green and physical gold in the bar charts. You can see when the dollar trends down, we see gold heading higher. When the dollar heads higher, we see gold heading down. Because you can buy the hedge and then we see physical gold going higher and now you've wasted X amount on an insurance policy. So the insurance policy should be also timed with at least an attempt of precision. If you see, for example, the dollar being oversold or if there's a catalyst in the macroeconomics data that could spike the dollar, such as the CPI or such as the unemployment rate, or you see a bullish formation on the chart of the dollar, usually that makes the best times to hedge against your gold positions. So I hope that I answered a variety of questions around this topic right here. Here we have another question. God Reddit, RDDT 1018, 62 puts, dip buying starting. Should I dump it? For the Q&As and the Top Guns, we're preserving those for maybe a longer term kind of questions, medium term. For immediate responses when you need them, you want to use the chat channel or the conversation on the live stream. But we're going to try to answer this question for, let's say, if you have longer expiration dates or if you're stuck in these puts right now, what was the problem that caused you to be stuck in these options? If you look at the chart of RDDT, that's for Reddit. On the daily chart, we have a clear trend line, and then we have a gap. And it appears that we're having a hard time to make up our mind here on the chart, whether we trade above the gap or give it up and trade below the gap again. You see momentum on the daily chart, still positive, but it could reverse at any moment. So it is a point where we see consolidation in a really important resistance level, or zone in this case, where the gap is residing. If you're going to bet to the downside, before you enter any bet to the downside, you need to identify how far can the stock go down in the period where I'm picking my expiration date. Is 5% reasonable? Or is it 2%? Is 10% reasonable? Or is it 5%? That's question number one. Question number two is, what is my cut loss price target? And in this case, of course, if we close above the gap on a daily basis, then understand that the chart made up its mind and it wants to trade above the gap. And that's going to be your cut loss at any time. Now, the problem with the strikes that you picked, the 62, they're almost at the trend line, meaning that you're probably not going to see this kind of an oversized reaction in, say, a week or two. Usually for a big move like this, all the way down to the trend line, where 62 are probably going to be in the money, you're going to need a catalyst such as earnings. And that's not going to come out until the end of the month. So in this case, the mistake that you've made, you went way too far in picking your strikes. And you picked a shorter expiration date that does not include a catalyst. Now, if you picked November, and you went to 62, okay, that would have been a reasonable trade. If you wanted to do the October 18th puts, then you probably wanted to go with, let's say, the 68-65 spread or the 70-65 spread, because you don't have a catalyst. So you need to utilize the spreads and identify your cut loss precisely when to exit this trade. So I hope this answered your question. For next time, If you want to enter any trade in this similar circumstance, now you know what to look for. Here's another question, which is supposed to be in the chat channel, folks, not in the Q&A, but we'll answer it either way, and we'll look at the chart from a longer-term perspective. Thoughts on SQ, that is square, aka block, October 11th, 70 calls. Large rejection wick below the 20. That's the 20 days moving average, and the hourly chart looks great. This is what the viewer is pointing out to. We've seen a sort of a positive reaction, preserved the 20 days moving average, not this Friday, but last Friday, about a week ago. And the viewer was asking, based on this candle, should I buy the 70 calls in square? Had they done that, they would have probably scored some gains. It didn't close in the money. So if you held it all the way till Friday, you probably lost money. But if you closed it Wednesday, Tuesday, you probably made money, which puts you in about 2-3 days to make your VIG. That's a really short time horizon. It's almost, in the case of speculative trading, than serious trading. You don't want to spend a lot of money in these kind of trades. But we have to look at square from a longer time perspective. Let's use the weekly chart. We know that the chart respects the Bollinger Bands. Once they get to the upper Bollinger Bands of the weekly, they go down. But once they go to the lower Bollinger Bands, we see buyers showing up. On the momentum indicators, so this time around, we got a reaction out of the lower Bollinger Bands, and now we're trying to expand the upper Bollinger Bands higher. And you look at the momentum indicators. The RSI is firming up. Your MACD is also firming up, beginning to show great impressions in histogram, meaning that we're beginning to see bullishness showing up. Likewise, the Vortex indicator, you see the blue line trading above the red line, so we know, at least in the weekly chart, square is beginning to show some bullishness, reversing the recent bearish momentum that took it all the way from, let's say, 83, 84 down to below 60. So with that knowledge, we know that this is a weekly chart, so it's going to take time for it to play to the upside. That means we need longer expiration dates than we think. Number 2, we have the upper Bollinger Bands as resistance. That's going to take a little bit of time for it to move higher and expand that Bollinger Bands. In other words, we have a menu of options here on how to play upward momentum in SQ square. Option number 1, you go to November 15th, just to give the weekly chart a few weeks to formulate. In this case, we're going to use a call butterfly spread. We buy the 70 calls. We're not going way out of the money because we're just a few weeks away from November 15th. If you're going to go to January or December even, you can go a little out of the money. But since we're tight with time, we have to pick closer to the money, but also reduce our entry cost as much as possible. And this is why we're using a call butterfly spread structure. In this structure, you buy the 70 calls, you sell the 80 calls 2-to-1 to your 70 calls that you bought. But now you have to buy something above the 80 since you sold more than what you bought. You have to buy the 90 calls as your insurance policy if the stock blasts above 80. All in all, according to the pricing that we have over the weekend, of course, there's a wide spread between the bid and ask and the 80 calls because trading is off right now. But let's say the price would cost you about $190 per contract. And the maximum profit you can score from this trade is about $800. So this is a really decent risk versus reward. If you want to go to a shorter expiration date using the same structure, the butterfly structure, you can go with the 25th of October as an expiration date. In this case, you're also going to be really close to the money because you're short in time. You buy the 70, you sell the 75, 2-to-1 once again, and then you buy the 80. That's going to cost you $1.18 a piece, or $118 with commission, so about $115 without a commission per contract. And your maximum profit will be about $380. Again, not bad. If you don't want to do a butterfly structure, you want to stick with the November 15th, you want to do a regular debit call spread, then you do the 70 calls, you sell the 80 calls 1-to-1, cost you about $325 to make $675. Again, not bad. But in this case, if you want to ask my preference, I would do the November 15th call butterfly structure. Here's another one. Hey Maverick, I bought at the money 120 calls for XOM, that's ExxonMobil. The expiration date October 25. And RTX 125 130 calls for November 1st. Should I go further out? So this is probably a bet on geopolitics. Let's take them one by one, beginning with XOM ExxonMobil. Now I did buy the shares at 122, exercising some call options. So we're in the same boat. What's really important is to assess the risk from here. What if we sell the news, we don't have a strike on the oil facilities? Then you see a lot of folks who've been buying upside calls on crude oil, dumping these calls, which will impact ExxonMobil negatively. So assessing the risk is really important. And in this case, it could be a failure here at 123.75, and we do an inverse ABC reversal. So here, we do have a risk, and we can discuss how do we hedge against that. You can buy the weekly USO puts, for example, or the bi-weekly ones. They do them on Wednesdays. They do them on Fridays too. But if we cross above and close above 123.75, then we're likely going to challenge the highs. And ExxonMobil can continue to move higher. So right now, you got the 25th of October expiration, so time is really tight. The good news is you're in the money at the 120. So you need some hedging policy here. Just in case you wake up one day and ExxonMobil is down 2-3% now, your contracts are out of the money, and you have a profitable trade that turns into a losing one. Another hedging strategy that you can do besides buying puts on a proxy like USO, you can actually sell a debit spread. In this case, you can sell the 126 since we know that the previous highs was about 125, and we're going to find some resistance at that level. If you sell the 126 calls, you can raise about $1 and knock down your entry cost. That makes the trade, or at least the probability for the trade to be profitable higher. The only downside of using this strategy is what if we see a strike on our Iranian oil facilities or refiners and we see a huge pop in Exxon that takes us within 2 weeks above 126, then your gains will be limited to the $6 gap between 120 and 126. So again, you have options. You know what your risk is right now. Pick whatever hedge you want to do with it. But do you need to go further out? That could be another hedging strategy. But before you go further out, you need to take the previous highs where ExxonMobil failed at. Otherwise, you have no confirmation that you're heading higher. There's no point of wasting money by extending the expiration date on a contract that's already in the money. I think the conversation right now should be, how do I hedge in case it fails and goes down? As far as RTX, the 125-130 call spread for November 1st. Let's look at the chart here, daily chart. We have a positive trend. We have bullish momentum right now, but maybe beginning to fade a little bit. Of course, we know if there's a flare-up in the geopolitics, we'll see RTX expanding higher. And your 125s are not really way out of the money right now. We're trading at 123.93, so it's about $1 or so out of the money. Not a big deal. But I usually begin with, what is my risk? Instead of asking about, hey, should I expand the expiration date? Again, expanding the expiration date. If the trade goes the other way, then what is the point? You're just assuming a bigger loss. So in this case, we need to assess the risk before we do anything. And right off the gate, you see the breakout candle, the green candle, where we see the reversal from bearish to bullish momentum in the MACD indicator. You take half of the body of that candle, that'll be 122.25. If you close on daily basis below that number, then technically we have a failure. We're probably going to go down, revisit the trend line, see if we can find support or not at that point. And your call options, the spread will be a loser, at least up to that point. So right now, I would say you have enough time all the way to November 1st. You don't need to extend the expiration date, but you need to set that stop loss. If we go below, then you'll be in the safer side. You exit and you come back once we trade above again. The only risk you're going to assume in doing that is, what if the hit happens right after you sell your shares of RTX, or your call options in this case? Then you're going to miss the pop. But you have ExxonMobil. So you have a little bit of a redundancy here, and that gives you flexibility for at least taking one trade off the table if we have a risk of a technical breakdown where your options become out of the money or a loser in the case of RTX. Okay, we have another one here, a little long of a question, but really important. And it ties in with this question of ExxonMobil. The viewer says, one of my favorite moves I've learned here is how to utilize calendar/diagonal spreads. I recognize that selling a contract to raise premium against the one I currently hold has the potential to blow up a winning trade. But it is exciting to get cute like that and nail it. Now, two important things to understand. If you have shorter expiration dates, you pretty much always have to pick spreads because the spreads offer a hedging strategy right off the gate. It reduces your entry cost and it defines your profit. It doesn't make you a loser. It doesn't make your trade a loser. It just defines the limitation of your profits. But the beauty of having spreads is it gives you the flexibility. Say you buy a call option spread with 2 weeks till expiration, a little out of the money. Then the stock actually goes down, the opposite reaction. And we have some trades that we've done this week that acted that way. If you have the naked calls, well, you just lost money on them and you can't do anything about it right now. But if you open a debit spread, a debit call spread, now the leg that you sold decreased in value, meaning you can buy it back and pocket the difference as a profit. And then you have the flexibility to do something else with the naked calls now that you got, either open diagonal spreads on it or calendar spreads on it, and reduce the entry cost even more. If you believe that the stock is going to recover and move higher again, and your options will be eventually in the money. Now, when you say blow up a winning trade into a losing one, we see that when we do the lottos and pre-earnings plays, when we do calendar spreads, calls or puts, meaning you sell this week where earnings are being reported and then you buy the next week. If the reaction of the stock is bigger or exceeds the limit that you bought your calendar calls or puts at, then in that circumstance, you limit it to the time premium between the calls or the puts that you sold for this particular week and the calls or the puts that you bought for the week after. That's going to be the only gain that you can assume, the time value, which again, given what the entry price is, 9 times out of 10, your trade is going to be a loser. So that's the only circumstance when you actually lose money. But this is why we do lottos, like we did with Nike, for example. And that trade scored triple-digit worth of gains. Is it going to happen all the time? Of course not. Most of the time, the lottos will be a loser in the case of doing calendar spreads or calendar puts because you're trying to outsmart the market maker. And again, 8 times out of 10, you're going to lose trying to outsmart the market maker. We continue with the question here. Thinking of the 1025 call contracts I'm in that holds excessive gains at the moment. The idea to open a spread and sell a short-term call that is further out of the money and expiring at the end of the week sounds so sweet, meaning a diagonal call spread. But I don't think this is a good idea because I know there's a number of catalysts that could cause my contract to blow up instantly. And that would hypothetically make the contract I'm selling to be in the money, thus jeopardizing the play that is already a big winner for me. I disagree. The only risk you're assuming by doing the diagonal spreads in this case is limiting your profits, but you're not jeopardizing any of your gains. And what if the stock goes down and now your gains are trimmed? Wouldn't you be glad that at least you captured some premium that compensate you for the loss in the meantime? Think about that. My question is regarding what I assume is a different side of the same coin. I'm familiar with selling a contract that's going in the same direction of my underlying trade. But I'd love to hear you talk more about the strategy of selling contracts that has the same sentiment, being bearish or bullish, but betting against a move in the opposite direction. For example, I'm printing Play-Doh with the ExxonMobil 120 calls for 10/25, the expiration date. I don't think I want to limit my potential gains by opening a spread in this sector right now. The diagonal calendar call play is inciting for this week's end, but we know things could get so much hotter so quickly. So then, what about selling a put instead? I'm particularly thinking about a shorter term expiration, say the end of the week or next week. To sell the 118 puts for this week or even something like the 115 or 114 puts for next week's expiration could capture a significant amount of premium I paid originally to enter the trade. Can you address the risk versus reward repercussions of how this strategy works? Does the risk essentially work the same as it would to sell a call at a higher strike? I guess on this play, I'm still more bullish than bearish at the moment. Well, we know since this question was posted, ExxonMobil actually dipped down. And the problem with selling the puts in this case, another bullish strategy, so already have the calls and you're selling puts. Unless you want to buy the stock at that strike price where you're selling the puts, you're assuming a lot of risk. If there is a reversal in the stock and it flushes down dramatically and these puts become in the money, you'll assume a significant loss on your put options, or if you exercise and you buy the underlying equity at the strike price where it's trading below by the expiration date. So that's the risk. The reward, of course, if we don't go down, if the catalyst is still intact but extended, as we see with what's going on in the geopolitical situation, then selling the put makes sense. But if you look at the options pricing for any energy stock right now, for even crude oil or USO, you will see that the call options premiums are way higher than put options. Why? Because everybody's betting on it. The demand for calls is way higher than the demand for puts. So in this case, if you want to capture more premium, you'd actually want to utilize the diagonal spread strategy of selling an upside call with a shorter expiration date, or even the debit call strategy, limiting your gains, sure, in case we get a pop, but you have to understand that you have a shorter expiration date. You have about 2 weeks till expiration. You don't have the luxury of holding into your naked calls that are in the money right now and then risk that they become out of the money. So I think in this case, you want to think about hedging more than you want to be greedy at this point. If you want to have a sweet balance between being greedy and hedging at the same time, then you can open the call spreads, diagonal or debit spreads, at a lower quantity. So let's say that you have 10 of the ExxonMobil 120 calls. You can sell the 125 at 5 contracts instead of 10, whatever expiration date, diagonal or debit spread. That way you have a sweet balance that if we go down, at least I got something in my pocket that mitigates the loss on the original contract that I own. If we go higher and we blast above the 125 strike that I sold, then okay, I'm going to be limited on half of the contracts that I got, but the other half will ride higher. That's a sweet balance you might want to consider. Here we have another one. Mav, thanks for the CL, that's crude oil, heads up. Currently I have 5 contracts of December 24th, 71.5 calls. Does it make sense to add on this position through Jan 25? Take profits accordingly. Your guidance is appreciated. So we look at crude oil. Again, we're assuming right now, since we got a weak hands kind of move getting out because they were frustrated that the strikes didn't happen at the time they were expecting them to happen. So we got a drop in crude oil. And of course, China went down during the same time. So China could have had a bigger impact than folks being frustrated that the strikes didn't happen at the time they were expecting them to happen. But then we've seen a reversal and a rebound higher without confirmation, though, because we didn't close above 76, which is the resistance line. But the risk right now is we form an ABC breakout. If we get the strikes and the flare up in the geopolitics in the Middle East, we will get a spike higher and blast above the previous highs. That's the opportunity. In your case, you have the 71.5. You're deep in the money. You have a longer expiration date all the way till December. I would say probably more than what you need. So there's no point of extending all the way to the 25th. I don't think Israel is going to postpone the strikes all the way till December. Either this is going to happen by the end of the month or it's not going to happen. So November would have been sufficient, but again, you have December, you have more time value in your contracts. There's no harm here. What we need to think about is hedging strategies. So I got deep in the money contract, 71.5. Let's say that I'm betting on an explosion higher, but at the same time, I'm kind of worried that crude oil might go down. So I want to hedge. How do we hedge? You can book half of your profits, let the rest ride. That's strategy number 1. Strategy number 2, you can sell upside calls as a diagonal spread. The only problem is they're going to limit your gains if you have a big pop higher. The third option is to book your profits entirely and then roll to a higher strike. So you have 71.5. Now you want to roll to, let's say, the 77 or 78 strikes with the same expiration date. That way you have some money, some profits that you have in your pocket from booking the 71.5, and you use some of the profits to roll all the way to a higher expiration date. I would leave the choice entirely up to you. Bill the Thrill says, what do you think about PLTR Palantir, December 20th? 40 puts cost about $370 right now. I don't think this is the time to short Palantir, though. When I look at the chart, the daily chart, I'm not seeing any reversal candle. I know it blasted way too high and the stock is overvalued, got it. But you need to see a reversal point where the holders of the stock say, you know what, it went way too high, too far in a short amount of time. I'm better off booking the profits and rotating to another opportunity. And until you see that, maybe we do have sort of a doji candle on Friday, but that's not a topping candle. That's a possibility of a topping candle. You need to see a topping and a confirmation candle, a reversal candle, bearish engulfing. That would be an example. Then you can enter the puts. Besides that, you're assuming the risk that you could short right now at this point, then it keeps going higher. Now, you have to understand one thing, that when growth stocks join the Dow Jones or the S&P, we call that graduating to the cemetery because that's when growth stops. Instead of becoming an explosive stock, it begins to go down. But it takes time for that to happen. The stock right now is way overvalued, so at some point, the sellers will begin to show up. And as they begin to show up, and you see reversal candle, then you can place the trade. But you don't want to place the trade just because something went way too high, or you want to buy the dip because something went way too down. You need to see those reversal signs first. Somebody selling before you. In this case, in the case of a stock that crashes down, you need to see somebody else buying before you. And then you're going to have plenty of meat on the bone to chew on. You don't want to be the first one into it. Then you time it wrong and now you're stuck in a losing trade. And the last one when it comes to options from Jimbo. Hey Maverick, could you talk about the unusual activities last week on DLTR? That's Dollar Tree. When you get a chance, question mark. Lots of strikes around 120, 130 for big premium where the price was at 71. Thanks. So looking at the chart right now, I don't think we're done going down. I think we've seen some shorts booking profits, but more sellers showing up. I think it wants to revisit 60.20 or at least find a higher low from this point on the weekly chart. We need to find where that point is. Buying the stock right now is extremely risky. Now, as far as the unusual options that you spotted, I'm showing them right now. Millions and millions of dollars to the tune of $65.5 million worth of a single trade that happened rapidly in a short amount of time. That tells you right off the gate this is an institutional/algorithmic trading mechanism. And in this case, they sold a lot of puts in the money, deep in the money. Selling these puts, what is the obligation? If you trade below, you're going to have to buy those strikes. So when they sell these puts with millions and millions and millions of dollars, what are they really betting on? That the stock is done going down. The stock will continue to go higher from this point on. And they can capture the premium from selling all of these puts that you see right here. The problem is they closed some of these trades right away. Some of them at a loss. They had to buy them back because the stock kept going down. So you don't want to read too much into it. This could be an institutional/algorithmic trader. And they spotted something to suggest that this is an opportunity to sell some puts, to raise some credit at millions and millions of dollars. They timed it wrong, for example. So they had to take it off the table. And they had to adjust the strikes and the expiration dates. I wouldn't read too much into it. Okay, let's segue to the technicals, and hopefully these questions will be a little easier to answer. Firecat says, thoughts on CAG Conagra. Will it rebound? Question mark. To about where? Question mark. Thanks, really appreciate your effort to teach us. Hope you're healing well. I went through this surgery and it was difficult for me. I feel your pain. Thank you so much. I appreciate it. As far as CAG Conagra daily chart, we see right now, number one, we have a falling wedge pattern. We're beginning to break above it. That's a good sign. What else do we see? You plug in the 200 days moving average, we're above. And that's really important because if you plug in your Bollinger Bands, the Bollinger Bands have expanded to the downside, meaning that there is more room to go to the downside if the stock loses the 200 days moving average of support. So if you're going to buy Conagra at this point, your cut loss will be the 200 days moving average. You trade below, you're heading lower. You maintain the 200 days moving average, then you're probably heading higher. We know that Conagra, a dividend-paying stock in the defensive category, depends on bond yields going down for the wrong reasons, recessionary reasons. We might see a pullback in yields, but so far, they've been heading higher. So if you want to enter Conagra right now via calls or shares, just make sure that you have your stop loss at the 200 days moving average. We're not too far above, by the way. Then we have Big Bob Trader, says Maverick, the daily candle in the Qs in NVIDIA today, is that a hanging man candle or a dragonfly candle? Thank you. The question was back at 10/4, October 4th. So let's look at these candles. This is what the trader is talking about on the Qs. Dragonfly, or is it hanging man? The terminologies don't matter to me. I've been doing this show for about 4 years right now, and you seldom hear me talking about candlestick formations. They're cute, but they mean nothing at all. Without context, they mean nothing at all. In this case, we know that this was a Friday candle, options expiration, and what we can see from this candle is we traded down, and then we reversed by the end of the day, closing at the highs where the trading opened. In other words, this could be an options/mechanical phenomenon where the market maker opens at a certain price, exercise maximum pain in the puts holder for that week, then drops the price down to exercise maximum pain in the call options holders for that week, and then move the price back up to accommodate calls for longer expiration dates. That could be all there is. Furthermore, you have to look at the weight in the Qs, the bigger names. And if you look at NVIDIA, it has an identical looking candle. We know that during that week, NVIDIA was under a mechanical phenomenon where folks were buying calls excessively, then buying puts after that. So I think in this case, and we talked about it in details in Discord if you recall, we actually nailed what the market maker is going to do. They're going to push the price below 125 if you recall, and then push it back and close it flat. And this is exactly what happened. And the action in NVIDIA influenced the candle in the Qs, so you can't really read too much into it. All what happened is the mechanical phenomenon during an expiration week where we've seen excessive call and put options buying in NVIDIA, which influenced the chart of the Qs and possibly the SPY. Small family office, please explain the huge overnight moves of the market, not based on earnings, aka market anomalies? Question mark. Participating for retailers is impossible or risky. Thanks a lot. The first thing that happens overnight is the influence of overseas trading. That happens in two ways. The algorithms look at, for example, what's going on in China, Shanghai, Hang Seng. Then they look at Europe. Once we have European exchanges opening for trading, and they influence the action in U.S. futures. If you see positive trading in Asia and in Europe, then the assumption is it's probably going to be positive in the U.S. market. And we see the futures moving higher. The other factor is overseas traders, not just the algorithms, but the traders. If they're buying in China, buying in Europe, they're probably going to buy in the U.S. So they begin buying in the futures session because that's the only U.S. market that's open to them. So we see this kind of phenomenon of the futures trading higher during the overnight session, and then once we open, we see traders here in the US who wake up, all of a sudden they're sitting on gains. Thank you, Asian and European traders, and they book profits right away, and we see a flush. And vice versa. If trading in Asia and Europe is not good and the traders are dumping, and we see futures in the US going down, American traders can wake up and see the prices down and say, thank you so much, folks. You gave us a buying opportunity. And we see the flush turning into a V-shaped recovery right away. That depends, of course, on the circumstance and why did we see selling or buying in Asia and Europe. So context really matter. The third phenomenon, and usually that happens within, let's say, 2 hours before trading in the US opens. There's something called painting the tape. Now, painting the tape was popularized back in the 80s. It's been going on in one form or another since trading began. But it became a phenomenon in the 80s. But back in the 80s, they would do it after the open in the US market because the use of algorithms and computerized trading was limited back then. And painting the tape in the 80s and 90s was, as soon as the market opens, the traders begin to flood the market with buy orders. And that causes the equity price to go higher. And then more and more buying ensues. Then the traders can book their profits since they bought earlier in the session. But we don't see a negative impact on the price of the underlying equity because there is more buying happening because of the painting the tape phenomenon. Now, in today's trading, we have algorithms, and they do that in the pre-market session. They buy, for example, the Qs or the SPY futures, pushing it way higher. We open at that price, then the traders immediately after the open book profits. But because we have orders that showed up based on the action that we see in the futures market, buy orders in this case, we don't see the Qs or the SPY in whatever case we're talking about going down significantly. And the traders whose algorithms bought, they wake up at a profit, they book it right away, but we don't see a flush phenomenon because the tape has been painted, meaning other participants began to buy based on the influence of the pre-market session. That was a good one. How about this one? D-Dub, what strikes and dates are you doubling down on NVIDIA? Currently reacting at the Fibonacci 23.6, missed the big move down. The question, what was back in October 1st? You're probably glad that you didn't short it at that point because NVIDIA went higher after that. And my guideline is, if we're trading below 115, then downside bets and downside momentum has the better odds. If we're trading above 125, then upside momentum has the better odds. You can see immediately once we trade below 115, we see a big flush down. Once we trade above 125 and we close above 125 on the hourly chart, we see big reactions to the upside. So we know that these two numbers are important. Now, on October 1st, when you asked that question, we were just a touch above 115. Had we closed below 115, I would have doubled down, added to put options or shorts on NVIDIA. But now, since we're above 125 and we closed above 125, then the call options have the better odds. And if you've been short NVIDIA via borrowing the shares, your hedge was the call options at 125. And that worked out tremendously. Now, if we lose 125, what is that going to do? Eliminate the upward risk, diminish the odds of more gains. But would it really trigger the odds to be more favorable toward more downside or flush downs? Not really. Not until we lose 115 again. So keep this guideline in mind. You lose 125, the story change more on the side of if you've been long NVIDIA, you should consider booking your gains. If we go down below 115, then the story changes toward, hey, be careful, you might want to exit NVIDIA or short it. We got another good one here. From a technical analysis perspective, would you consider CRWD on a daily bull flag pattern What are your thoughts, weekly, monthly outlook based on the chart patterns and macro? I'm curious to see if the pattern coincides with a macro outlook. Then you have another question on oil we're going to answer later. Let's begin with CRWD. The trader is pointing out this pattern that I'm highlighting. Is that a bull flag? Not really, because there is no defined pole. And even if you can draw a pole, the flag went down below half of the body of that pole. So technically, it's not a bull flag pattern. It's more of an ABC kind of pattern. And you had some confirmation lines. You had 285, confirmation number 1, that this is perhaps an ABC breakout. And then a confirmation that it is, for sure, an ABC breakout is 302.16, where we stopped in the A leg. And right now, of course, the risk becomes when you have an ABC breakout, you take the measurement, and this is an approximate measurement of the A leg. The C leg will be equivalent to the A leg, at least. In this case, it should take us all the way to, let's say, 335, 336. It might expand all the way to closing the gap at 336.34. And then we're probably going to become a little overbought in the daily chart and pull back. What's really important in CrowdStrike is the weekly chart, because it got knocked down pretty good. And now it's doing a rebound that's not even at half of the body of the breakdown momentum that we've seen. So this is just an oversold rebound in the weekly. It looks big on the daily, but it's only an oversold rebound in the weekly. And the risk is if we expand the MACD indicator, usually we end the wave, because the wave was bullish and it ended once the MACD crossed below the zero line. Usually we see buying from the shorts, covering their shorts. We see some dip buyers, some momentum traders chasing the move. And we see a little bit of bullish momentum showing up as to show that there is perhaps a recovery. But usually after that, there's a failure because more sellers are now beginning to sell at better prices. They've been stuck at a loss for a while. Now the price is a lot better, so they begin to sell. So usually we see these recoveries not happening in a V-shaped recovery, but rather a double dip kind of recoveries, if they happen, because the other scenario that we can look at in the weekly chart, what if this is an inverse ABC pattern? And right now we formed the A leg, we're forming the B, and then we're going to slip down to a C leg where we make lower lows. So understand that the daily looks bullish, the weekly, you ain't out of the woods yet. So we have to look at certain resistance lines that we can use as confirmations that the inverse ABC risk is not a concern in the weekly chart. If you use Fibonacci retracements, in this case we have 299.57, a weekly close above, will indicate that perhaps this is not an ABC inverse pattern. It will be closer to a V-shaped recovery. Then, of course, the ultimate confirmation will be 356.06 on the weekly chart. So you have a few numbers here to look forward to. Because, by the way, 356.06, that'll be in or around what could be a shoulder line in a head and shoulder pattern. In other words, what I'm trying to say is CrowdStrike is not really out of the woods. You're better off actually buying HACK, the ticker HACK. That's the cybersecurity ETF. And I've been saying for months now, in technology, I like the value, which is IBM, but now IBM is way too hot. I do like the IGV software, and I do like HACK cybersecurity. The chips, the big caps, I don't. Let's go back and hear what I said about HACK just a couple of months ago. What about the ticker HACK, HACK? This is the cybersecurity ETF. And with this guy, the first observation is it caught a major rebound. It's back at the highs again. And we see the weekly MACD actually changing back to bullish. So this one looks a lot better than the rest of the charts we've been looking at so far. I also got the possibility of a cup and handle pattern. The confirmation that this pattern is indeed playing out, and we have a breakout here, would be a weekly close above 68. And here's the update. You see the breakout. This is a much better looking chart than CrowdStrike. You're not putting all of your eggs in one basket of CRWD. You're having exposure to a better company like Palo Alto, and perhaps a recovery in NET, Cloudflare, and you have other names under the ETF, so I'd rather be in HACK over CrowdStrike. Here's the second question that you got. You have mentioned oil is easily manipulated. At what point or what data would you have to come out that would cause oil to move and stay in its true direction? Can we go long oil since we're now above the 20 daily moving average? We go to the chart of crude oil. The answer is yes. It is easily manipulated, but in this case, the shorts gave up because we have multiple catalysts from China stimulus, from the geopolitics, from the Fed cutting rates that should push the price of crude higher. What's really imperative about this crossing that you're talking about above the 20 days moving average, check out what happened in the MACD indicator. It was about to reverse from bullish to bearish. That pop above the 20 days moving average. So The 20 is not really that important. What's important is the reaction around the 20 days moving average from other momentum indicators. The MACD at that point reversed back to bullish, expanding the bullish momentum. And most importantly, if we look at the volume as a momentum indicator, clean up the chart a little bit so we can see. Huge volume showed up during that candle. That's also known as a reversal candle, reversing the bearish momentum to bullish momentum. So yes, once you've seen that volume and the reaction that we've seen in crude oil, that was the buy signal right there and then. We got another one here. Hey man, first, thank you for all of the effort that you put into making the videos. Second, I have seen that you have been advocating for Chinese stocks, BABA specifically, and you're not wrong. What would be the sign that the party is over, quote unquote, in BABA or in the BABA corner, question mark. Here's the weekly chart of BABA. We've been talking about a possibility of lower highs, higher lows, a tension pattern that could resolve to the upside. And we've identified 87.83 as a number to look forward to. It's been a point of support before. It's been a point of resistance before. So once we see a break above, you're probably going to see all of that energy being released. Now, we're lucky enough that not only we got a technical break, but we got also a fundamental catalyst from China's stimulus that caused a lot of buying, and we've seen a huge break to the upside. The other number was 103. We've also seen some reaction around that number. So closing above for the week was the confirmation that the bottom is in. And higher we go for BABA. We've beaten 2 resistance lines in one candle. What is the next number to look forward to? It's 121. We've seen that point being support and resistance before. The party is over means that you got a bearish reversal, that the pop was fake. So the party is over is not only losing 103 from a weekly standpoint, but also reversing and losing 87.83 as support. I don't see that as a plausible scenario. I see maybe we hit to 121 and then we pull back. We might lose 103, but so long as 87.83 is intact, then the bottom is already in. And we're probably going to see a dip in BABA because it's overbought right now in every metric you look at. But the dips will be bought and will head higher from this point on. Unless, of course, there's a reversal in the fundamental news that caused the technical breakout. See, a lot of purist technical analysts, they say the fundamentals don't matter. The fundamentals, they call it. But in this case, the technicals followed the fundamentals. That's why we say that the fundamentals actually do matter. And you're not going to see parties over until the fundamentals, in this case, reverse. Here's another related question from NVDA. What are your thoughts on BABA short to midterm? As it seems to keep going higher every day. This question was back on October 2nd. I've been holding shares and I'm considering doubling down, but cannot seem to figure out the best timing to do that since the anticipated pullback keeps being delayed. Would you recommend waiting for the pullback and playing catch-up via call options WIN and F? Or shall we say WHEN and if? WIN is another ticker within China which played out pretty good, but when and if the upward momentum resumes, question mark. If you've been following us on Discord, and I know you've been following us, we have nailed the pullback in China to the penny. I said once Shanghai opens for trading after the holiday, we will see profit taking. A lot of folks attributed the pullback to, oh, China's not going to issue more stimulus and yada, yada, yada. No, it was just a sell the news phenomenon. And before that happened, I suggested that you buy some puts or KWEB or FXI and sell some covered calls in addition to buying the ticker YANG. YANG, the inverse index for China 3 times. And that index scored above 40% in one day, whether you used it as a hedging mechanism or a trading mechanism. Now that we got the pullback out of the way, we're anticipating a reversal back to the upside. We got some good news on Friday, but it's not confirmed yet. But you know, at least in BABA, it would be closing above 121 from a weekly standpoint. I don't think it's going to happen right away, because if you remember what I said about China, the easy part of the trade is the short covering phase, where you get the initial news, the stimulus news, that causes short covering. The harder part comes after that, because now we're going to begin to look for other positive tailwinds or catalysts to continue to move higher. Otherwise, we're going to face profit taking. So I think it's going to be a little bit of a jittery reaction here, a struggle between 103 and 121 in Alibaba. But then in time, we're going to break above 121 and head higher. Here we get a question from MPH. The indicators a few months ago and previous were when the dollar goes up and yields going up, the market goes down. It seems to have gone haywire after the cuts. Is this correct? Question mark. Or am I just seeing things? Question mark. You're sort of right that when the dollar goes up, when yields go up, usually that's not positive for the market. But once you get into a cutting cycle, the question becomes, are we going up or down for the good reasons or the bad reasons? If yields are going up for the bad reasons, as in inflation going higher, Well, that's not good. But if yields are going higher because, the cuts will recover the economy, and that's the good reason. So context matters at this stage. The other thing you have to keep in mind, when we look at the rope strategy that we have, you look at the pick category. You have the dollar sensitive, you have the yield sensitive. If the dollar goes down, these stocks go higher. If yields go down, these stocks go higher. These are the most sensitive correlation to the dollar and bond yields. The rest of the stock market is not that sensitive. The pick category, it may care about bond yields and the dollar, but it also has other things to consider. The rent category in the big caps, the AI mania, they don't really care much about the dollar and bond yields going higher. Unless the dollar moves significantly higher, then of course overseas revenue will be trimmed. And that's going to be a bad factor for the big caps, the technology companies. And this is why we say that the big caps and the AI mania is a sphere of its own, meaning the Fed policy and the movement in the bond yields and the dollar matter, but to a limited magnitude. At the end of the day, they depend on, do we see more spending in the sector or not? We know that we have a few sugar daddies, Microsoft, Meta, Amazon, but mostly Microsoft. They're funneling all of these billions of dollars into NVIDIA. At what point do they stop the spending, or at least reduce the spending? That's when you begin to see that bubble frizzling out. And this earnings season is without a doubt more important to the big caps and the AI mania than what the Fed is going to do and not do, or the dollar is going to do and not do, or what the bond market is going to do and not do. And guess what moves the indices, the SPY and the Qs, the market, as you say? It's the big caps. It's the AI mania. And this is why I say if this earnings season shows peak in the revenues and the expansion in these companies, then the AI mania bubble will go bust. The big caps will go down. And that's going to impact the indices down. But you might find other corners that actually outperform, be it the dollar sensitive, the yield sensitive, the pick category, or the long but hedge category, which, by the way, a lot of these names in the long but hedge category are also yield sensitive to a certain magnitude, at least in the case of GLD Gold, very sensitive to the dollar. The telecoms, AT&T, Verizon, really sensitive to bond yields. Same goes to IYR real estate, but to a certain magnitude, meaning less than the yield-sensitive category of the IWM, KRE, XBI, XHB, ITB, and Blackstone. So keep that in mind. And the last question we got in the technical category, Mav, can you postulate on the end-of-the-day rally that happened 10 minutes before the bell closed? Massive support for Apple in the last 20 minutes of the day. Is this market maker games bull trap? I just love to understand. We were trading down about 30 to 51 points in the indices all day, then you see a big pop toward the close. So again, this is a time-sensitive question, but we can revisit this phenomenon. Why do we see sometimes equities down, but at the end of the day, we see a big pop or a surge higher at the end of the day? If you have options expiration, of course, the market maker will have an influence in that. But the other phenomenon is if you have a tape where, let's say, somebody is shorting, in this case, hedging by buying put options, the VIX goes higher. But we usually see that at the beginning of the day. We see the VIX gapping higher, at least recently, because folks are hedging overnight. They're not sure what's going to happen. We have a lot of problems with the geopolitics, with the yen, with China, with all of that stuff. So we see hedging happening. At the end of the day, when all the news is already played out, and the trading already played out, and they figure out that they don't need the hedging right now to hold the hedging overnight, they take the hedges off, and the VIX goes down, and the algorithms looking at that, they begin to buy the SPY, the Qs, and they push, of course, the heaviest weight stock in these ETFs, which is Apple. They push it higher. And this is why we say that Apple is the most sensitive equity to the VIX. And to be honest with you, recently, this has been the phenomenon of why we see big, sharp moves higher at the end of the day. It's folks who hedged, and they figure out that they don't need the hedges anymore. When we see flush downs, it's the opposite. Folks who didn't hedge, and now they figure out, you know what, I need a hedge overnight, because there is something that could happen overnight. And we see a flush down. Okay, let's move on to the other category in your questions here for the top guns. And here's the really good one. Hey, Mav, I'm in Guam right now, so I can't always catch your videos you do during the market trading hours. I know you put out a lot of valuable information since I've joined, and I don't want to make more work for you to do. But is it possible for you to organize your videos better on Patreon so that certain topics are easy to find? You've done videos regarding how to execute certain trades. Can they all be done in one place? In topics like the market maker that are, at times, you will say he wants to get to the price to the close below a certain number, but I haven't been able to grasp, is the market maker a real person or an algorithm? How exactly are you able to look at the calls and puts and say that? I'm wondering if it is too much work. Can you kind of do a beginner class on the market maker and work all the way up to more seasoned levels so I can understand that aspect of trades? Or if you've already covered it, can you clip it and put it in an easy to find location? You've also did videos on how to hedge. Can you also somehow pull videos like these to the front? You have a lot of good material, but it's difficult to locate them after weeks pass. So even in Patreon or on YouTube, you'll find a playlist. In Patreon, I believe it's called a library. But we segment the videos into daily videos, and the weekly videos, live streams, live stream highlights, options 101, all of these video categories that we do videos based upon. What I haven't done is organizing via topics for the smaller segments within videos. So when we talk about the market maker, sometimes we talk about that in a morning brief on Discord. Sometimes we talk about it in a video like this. I mean, think about the topics that we covered in this video alone. You can make videos out of this video. And maybe this is what we need to do. Problem is I don't have the time to do that. I know a lot of you offer to do that. Hey, Mav, I'm going to clip a certain segment of a video. I think it will make a really good video on its own. And I'm just going to send it to you. And that's good. That's going to save me a lot of time. But understand that the topic of market maker is a widely popular topic, at least in this channel. You're not the only one asking about it. Because if you look at YouTube or even in the media or CNBC, seldom when you hear somebody talking about the market maker, what they're thinking, what to expect in a certain expiration date. Matter of fact, all of the websites that most traders go to find the maximum pain numbers are fugazi. That's not the real maximum pain numbers. We give you the real ones on options expiration on the morning briefs. So because I've seen a lot of requests about the topic of the market maker, I think it deserves a full video on its own. But again, if you guys can show me, hey, in this video, for example, you talked about a really valuable aspect of the market maker. Can you clip that in a separate video? Then we'll do that. But even for me, I cannot think of which videos I talked about the market maker. You guys need to point that out for me and help me out a little bit so I can find the segments, clip them, and perhaps add them to a certain library of collection of videos for the topic of the market maker. But definitely we'll try to do that going forward. And folks, the last set of questions I want to cover here, you can see them for yourself. A lot of folks are talking about, and again, my bad, I should have explained more. But I said, folks, if you're a member in this channel, be it on YouTube or Patreon, and you decided to join using your iPhone and you use the apps, YouTube or Patreon, you ain't paying me, okay? You're paying Apple. In the case of YouTube, you're paying Google. So what Patreon has done recently is raising the prices on those subscribers using iOS, using the app in their iPhone, because creators are losing money paying the rent for the iMob. And here's the example. If you subscribe on Patreon using the website, meaning Patreon's website, not my website. I know Morgan, and I'm blanking on the name. Another member also messaged me on my website. How do I join from your website? That's not what I'm talking about. I'm talking about YouTube, the desktop website, and Patreon, the website, not the app. But you can see here, if you join using a web or Android, you pay $10. Patreon, of course, takes a fee, small fee, and the creator earns 8.61. If you join using your iOS app, using Patreon's app on your iPhone, in this case, you pay $10, the creator takes 6.20 because the money splits between Patreon and now they get to pay the iMob too. So this is why Patreon is now increasing the fees, or at least giving the creators the option to increase the fees on the members using iOS, using Apple iPhone to join. So an easy way to mitigate all of that is go to your iPhone if you're an iPhone user, look at your subscriptions. And if you see your subscription in this channel, Maverick Wall Street, in YouTube or on Patreon, under your Apple subscriptions, then yeah, you're paying the iMob, you ain't paying me. And the easy way to fix it is cancel the membership and then rejoin using the website of YouTube or Patreon. That way you're not going to have any price increase. And oh, by the way, on YouTube, you pay $10. If you're using an iPhone, the app, the YouTube app, Google takes 6%, the 60%. Then iMob takes 3%, not out of Google's cut. They take them out of your cut, the creator. And in this case, the Maverick of Wall Street is left shit out of his luck with $1. Now, I'm not going to complain a lot. I'm not a kid starving in Africa. So whatever I get, I'm thankful for. But I don't think that you guys want to pay Google and the iMob. You want to pay the creator, whoever creator, in this case me, or in any case, whoever else you want to pay. So to reduce the share that you're paying Google, and in this case, Apple, You want to subscribe using the website. If you're an iPhone user, the website, YouTube, or Patreon, the website. If you're using an Android, if you're using a website, a desktop to begin with, you're good to go. No problems at all. Anyhow, folks, this was a really good session. And this is why we decided to do Top Gun's Q&As, to give you an added benefit. And again, from this point on, the videos will be exclusive to you. So we're giving everybody a taste because I promised I would do it. And you can see the benefit for your own. That we go in each of these topics. Sometimes somebody posts a question on Discord or in the comment section. You can write a paragraph or a few letters answering the question, but it ain't gonna do it justice as if you take your time and you do a video about it, about all of these questions. So keep them coming, folks. You have the channel on Discord dedicated for this type of videos. We'll do them on a weekly basis. But for now, folks, this is all I got for you for tonight. A reminder, we're gonna do the market coverage tomorrow, and then we're gonna do the macro coverage on Monday. We split them. We're gonna do 2 videos for you here in the public channel. But once again, this is all I got for you for tonight. Thank you for listening. Thank you for watching. Appreciate and love all of you. And I'll be talking to you again tomorrow. And by popular request, here's Pink Floyd, Keep Talking, 1994. Enjoy.
Doesn't have to be like this. All we need to do is make sure we keep talking.